Losses in the Forex market are inevitable, happens to us all. But what's the real cost when you lose? Hello there, Andrew Lockwood here from forexsignals.com. Now, today I want to talk to you about the real cost of losing in the Forex market. I believe it's one of the biggest underestimations or traps that many retail Forex traders fall into is the lack of understanding of what an uncontrolled losing period can have on our trading and accounts moving forward. So what is the real cost of losing? Well, we all know what losing is all about. That's basically money going out of the trading account. We've all been there. We've all had our losses. Highly unlikely that we won't have losses again in the future. But what I'm referring to today basically is the drawdown and the implications that a drawdown period can have on the account. As you know, drawdown is basically the percentage in dollar terms, or whatever currency you're using, of course, from the highest value to the subsequent lowest value, basically from the peak to the trough. Now, most people don't realize it, but the drawdown can do a lot more damage to the account than you may think. So let's now illustrate this with an example. Let's consider two different performances on an equity curve. You've got trader A and trader B. Now, both aim to target, say, a 5% growth per year for the next 10 years. Now, we draw this on a graph. We have the time period on the horizontal axis, that basically out to 10 years. And then we have the vertical axis showing us the percentage gain or growth in that time period. So year one, both hit the target of 5%. In year two, trader B has a bit of a blowout. He has a losing period. He has a drawdown now of 24%. Now, for the following 8 years, trader B has to make double the targeted 5%, that's basically 10% per year, to make up for one losing year, just to achieve the same target as trader A, which is, in this case, is a gain of 63% or thereabouts over the 10-year period. Take a look at this table. Now, some pretty stark numbers in here, I'm sure you will agree. If you have a 10% drawdown, you need to make 11.1% just to get back to break even. If you have a 25% drawdown, you need to make 33% to get back to where you started. And look at this number. A 60% drawdown will require you to make a 150% gain just to get back to where it all began. Look, drawdown is an integral part of trading. Everyone's going to go through it. But what's important to know is how you need to perform after the drawdown period to get yourself out of that dip that the drawdown put you in. If you can appreciate the dangers of being in an out of the control drawdown, you may be more cautious about losing that control in the first place. And of course, one way to prevent this catastrophic drawdown is to trade with a smaller percentage risk. Now, clearly, if you have a back-tested strategy with a positive expectancy, you should have an indication of how the potential drawdown could affect your equity curve going forward. Now, if you like this video, if it made sense to you, give me a thumbs up. If you don't like the video, I'm a big man, give me a thumbs down, I can take it. As always, leave your comments. Have you been in that uncontrolled drawdown period? Have you been chasing a loss just to get back to where it all began, to get your money back to the break-even level? Leave me your comments, I'd love to hear from you. Until the next video, trade safe, speak to you soon.